The FTX bankruptcy left a $10 billion hole in the crypto world. This time though, along with customers, massive investment institutions like Sequoia Capital and others also took a hit. Despite the bankruptcy proceedings just beginning, these investors have already completely given up on receiving even a dollar back from FTX and its founder Sam-Bankman-Fried. So how did a company valued at $32 billion just a few weeks ago go broke overnight, and what's it mean for crypto? Hi, my name is Maaiz. I'm a hedge fund analyst turned entrepreneur, and on this channel I share what I'm learning about investing. Before I jump into how FTX went broke, it's helpful to see how Sam-Bankman-Fried, or SBF, became one of the youngest billionaires on paper in the first place. SBF started Alameda Research in 2017. He originally focused on the safest trading strategy available, arbitrage. Specifically, he would buy large amounts of Bitcoin and other crypto assets in one country and then sell them on the crypto exchange of another country, profiting from the difference in price. At the time, these differences in price occurred due to a mix of changing regulations that made it more difficult to buy or sell cryptocurrencies in one country versus another. This arbitrage was so well known, retail traders were also jumping in by buying on one exchange and selling on another. This premium in countries like Korea and Japan was dubbed the kimchi premium. I even made a few $1,000s doing it myself. Unlike most people though, SBF used leverage and money raised from investors to bet billions on this strategy and made solid money doing it. In this screenshot from a pitch deck from 2018, SBF shared that he can make high returns with no risk, with graphs showing 100% plus returns while the larger market was down 50%. Just take a look at these graphs showing the returns versus the market. As one of the largest traders at the time, SBF spent time testing and using the top exchanges across the world. SBF spotted an opportunity. He realized he was paying extraordinary amounts to trade crypto to crypto exchanges. Crypto exchanges work much like stock exchanges we know. Imagine the New York Stock Exchange or the NASDAQ. The difference is they run 24/7 and charge a lot more in fees, sometimes as much as 1% of a trade. SBF was especially sensitive to these fees, as his arbitrage strategy required paying these fees twice for each trade, along with fees to transfer funds between brokerages. When you pair these fees with the slimming margins in arbitrage trading, the logical next step for Alameda was to become its own exchange to save on the high fees charged by other exchanges. In order to build the largest exchange possible, FTX raised $1.9 billion from top-tier investors, including Sequoia Capital, SoftBank, and Tiger Global. Even celebrities like Tom Brady and Larry David joined the fund. FTX's timing couldn't be better, as Bitcoin and the larger crypto market continued to grind higher and higher with more retail money entering the market. SBF grew FTX on multiple fronts in ways other exchanges were unable to. First, he used his reputation at Alameda to entice top hedge funds to use FTX as their brokerage of choice. Even extremely conservative hedge funds like Galois Capital that called out Luna months before its implosion decided to put their money with FTX because the guys at Alameda were using it. Second, FTX plowed money into public relations. FTX sponsored the Mercedes-Benz F1 team, NBA's Miami Heat, and countless influencers. Third, SBF himself gave countless interviews speaking about his philanthropy and intentions to give away his money using the effective altruism framework. These three techniques worked extremely well. FTX soon became the safe exchange with institutional backing run by a nerdy but nice guy. Unfortunately, this campaign to legitimize and build trust in FTX worked so well that much of the world was surprised when FTX came out as one of the largest frauds in modern history. So what led to the fall of FTX and Sam-Bankman-Fried? It all started with Alameda's trading strategy. As we know, Alameda began as an arbitrage trading firm. This strategy is generally one of the safest, as you're not betting on a market direction. Rather, you're exploiting an efficiency in the market. Inevitably though, arbitrage opportunities disappear as markets mature. This is exactly what happened with the safer investments Alameda built its foundations on. In order to continue to make the kind of returns they had in the past, most trading firms moved to riskier strategies, such as investing large sums in the 20% Anchor protocol housed on the Luna chain, or even buying large amounts of Ethereum or Bitcoin in hopes that they would increase in value. If we've learned anything in the recent past, it's that it doesn't matter how big or shiny a company is, they can still make mistakes. In this case, it seems like greed got the better of SBF and FTX. Instead of closing up shop after no longer being able to institute their safer strategies, they decided to bet money on untested strategies, and they use massive amounts of debt to do it. Often in arbitrage, you can use large amounts of debt and be okay because you're not betting on a direction in the market. But FTX took their leverage to another level. In order to increase the amount of leverage they could take, they used illiquid cryptocurrencies such as the FTT token and Serum as collateral. Using these tokens that were created out of thin air, SBF borrowed billions to make up for massive losses after the Luna collapse. Furthermore, Nansen recently shared that FTX and Alameda manipulated the price of these tokens in the open market to get better terms on their debt. This part of the FTX story really reminds me of the evil geniuses out of Saturday cartoons. Sam-Bankman-Fried created the FTT token and kept 90% of the tokens and only made 10% tradable. Of the 10%, they held enough to be able to control the market for the coin. The full value of the FTT token hovered between $10 and $25 billion since it was launched. Since FTX owned most of these tokens, they were able to claim that they had assets of $9 to $20 billion depending on the price of FTT. Banks then gave them loans on these assets. FTX used these loans to help bail out Alameda from its losses as a result of the crypto crash in May 2022. The truly wild thing is, this isn't even the worst of it. Rather, what's worse is that you might have noticed up until now that I've talked about SBF, FTX, and Alameda as if though they are all the same organization. And it turns out they essentially are. FTX and Alameda have shared the same bank account since inception. There was almost no separation of funds between these three entities. Essentially, if you deposited money on FTX, your cash was going directly to Alameda, the same Alameda that had secretly lost billions in mid-2022. And that's not the worst of it. It seems SBF essentially treated customers' money as his own personal slush fund. SBF and other executives took out loans worth billions to fund political contributions and investments in other companies. This general attitude towards accounting continues to make it difficult for people to make sense of how much money FTX really owes. Turns out, SBF didn't care to keep proper records or accounting of funds from the beginning. Though bad accounting and poor investment skills lead to where FTX is today, most customers and investors are most angry with SBF's actions after they started facing liquidity issues. As interest rate hikes started to take full force in 2022, much of the higher risk investments around the whole world began to tank. Even top tech stocks like Shopify and Meta have lost 70% or more of their value. Crypto market was no different. This Glassnode chart shows the level of money that left the crypto market from a high of nearly $250 billion to about $24 billion today. As you can see, the vast majority of this loss was a result of the Luna collapse earlier this year. Luna was the algorithmic stablecoin and crypto chain that offered 20% APR to all users of its chain. In hindsight, such wild returns seem extremely suspect, but amid the crypto DeFi frenzy of 2021, Luna grew to $50 billion plus in value. On top of that, the largest players in decentralized finance were exposed to Luna in one way or another. Some are obvious, like BlockFi and Voyager, both of which halted withdrawals soon after Luna's collapse. Amid the carnage of the Luna collapse, SBF and FTX stepped in and bought Voyager and BlockFi, saving them from bankruptcy as a result of their losses. In this moment, it seemed that SBF was truly prescient and maybe the last responsible party left in crypto. Many applauded his bailouts as industry saving and dubbed him the JP Morgan of crypto.
Well, when Wall Street had its problems early in the 20th century, Mr. JP Morgan himself used to go out and say, I'm going to bail out certain companies, and you were called the JP Morgan of crypto.
Turns out his bailouts were simply an attempt to forestall his own downfall. Alameda was just as exposed to the Luna contagion, but by buying out BlockFi and Voyager, SBF was able to keep these companies from asking for their money back from SBF as they entered bankruptcy. His efforts to become crypto's savior were yet again the self-serving actions of a man running a scam with no one else left to scam. Now, the crazy part of all this is that I've only touched the surface of this story. Day by day, more information comes out about FTX, from a massive hack that led to funds being stolen soon after bankruptcy to revelations about how FTX spent customer funds. Given the massive amount of money leaving the crypto industry, industry, you should expect major consolidation in the near future. There are a couple reasons for this. First, money will dry up as institutional investors pull funding after losing on what they considered a sure bet. Tiger Global, Sequoia, and other top hedge funds have lost large sums over the last year. This dynamic, paired with a higher interest rate environment, will reduce the amount of new capital entering the crypto market. As a result, many unprofitable firms will either die out or get acquired by larger, profitable players. Generally, the players that will do best are those that are well capitalized and already leading. Think Ethereum versus Phantom. We're already starting to see a massive decrease in funding for crypto projects. This graph shows that funding is down 84% year over year. This decrease seems to be in line with the fall in the price of cryptocurrencies, as seen in previous cycles. As we move forward though, I expect less money being invested in DeFi projects and more on projects that are able to bring new use cases to crypto. Lastly, I expect the US government will more strongly pursue crypto regulation in the future. FTX had donated over $70 million to political campaigns over the last 2 years. Now that it's clear no more money is coming from FTX, politicians may look to please the masses that are underwater thanks to SBF's fraudulent practices. Now, if you're looking to avoid the next FTX, check out this video on the techniques Warren Buffett uses to tell the difference between frauds and the real deal.